Total Convexity, episode 16, is being recorded on January the 24th, 2025. I'm your host, Henrik Neuhaus, and joining me is my co-host, Jim Wang. After a long hiatus, I'm glad to return with this 16th installment of our podcast series. Given the inauguration of President Trump, there is a host of things to talk about. Trump wasted no time. On day one, he signed 26 executive orders, ranging from immigration and border security to energy to climate change to DEI policies and in other initiatives of the federal administration. In addition to the executive orders, President Trump also laid out other policy actions to be implemented in the near future, the most relevant topic of which for our purpose is tariffs. So far, Trump has indicated 25% tariffs on imports from Mexico and Canada, and an additional 10% of new tariffs on imports from China, or perhaps not, depending on what his most recent pronunciations are. Despite these proclamations, there is much we do not know about the president's actual intentions. Will there really be tariffs? If so, will the tariffs be targeted on specific countries and products, or will there be universal blanket tariffs? And if so, how much, what level will the tariffs be at? What are the implications on the economy and financial assets in general? Those are the pressing questions for investors. I thought it would be a great topic for our conversation today. What do you think, Jim?
Yes, Henrik. Hello, everyone. Those are the questions we ponder ourselves all the time, right? We ask ourselves, what would be the implications and what would Trump will do? And certainly we do not have the answers to them, but we do have a framework that we can share with our listeners. And because, as you say, this is a changing environment and everything can happen. But I think if we have a framework, then we can analyze it and see what are the uncertainties and how that can evolve. Among all the uncertainties, I would say tariff has the biggest uncertainty, right? We certainly have a little bit more clarity on deregulations, Trump energy policies, and his determination to renew or making his tax cuts permanent, right? So, and at the same time, the tariffs have very big impacts on the economy and also have significant implications on financial assets. So I think this is a great topic to start. Henrik, where do you want to start? Henrik?
Sorry, I was off. Yes, well, let's start from the beginning. The first question really will be, will there be tariffs or not? There's a lot of speculation that President Trump really is using the talk about tariffs as a negotiating tactic, and that the desired income actually is a set of negotiated deals with, say, Mexico, Canada, and China. What do you think?
Yes. So I think to answer these questions, we should come back to the basic question. What's the incentive for Trump to use tariff as tools, and what are the objectives he tries to achieve? And I think Trump's top priority is basically to renew the tax cuts enacted in his first term, which are set to expire towards the end of the year, or rather making them permanent. I mean, this would add about $450 billion per year over the next 10 years to the federal budget. At the same time, he's thinking about other tax cut initiative, although they are not that big. But if you round it, I mean, you are talking about $500 billion per year. So as we know, our federal budget deficit is around 7% right now, and this is only exceeded by great financial crisis in 2008, and also after the COVID shock. So we never had this kind of budget deficit under the peacetime, and mind you that we are at the historical low unemployment rate. So make tax cut permanent without further increasing the deficit. You either need to raise the revenue or cut spending, right? So Trump basically saying that he does not want to increase the tax by 45%, which is not going to go through. So what he's going to do? Elon Musk, he is heading the Doge project, Department of Government Efficiency, and he claimed that he wants to cut the government budget by 1 trillion, right? And we know that's not going to happen. Why? I mean, we just take a look at the numbers. So we have a 3.8 trillion mandatory spending, and that includes programs like Social Security, Medicare. So the discretionary spending, 1.8 trillion, among which more than 800 billions are defense spending, and the rest of them is non-defense discretionary, right? And then nowadays with the interest rate payment of debt is about 1 trillion. So if you cut, you need to have 50% of non-defense discretionary spending, right? I mean, that's probably is not possible. So I think if Trump is trying to broker a peace deal in Ukraine, and I think he will try to cut down the defense budget to a certain degree. And maybe he's able to cut down the non-defense discretionary spending as well because of the Doge, right? You add them up, maybe you can talk about a few hundred billion, right? So you need another few hundred billion. Where does that come from? So I think he is really thinking about using tariff to raise the revenue for the for the United States Treasury, right? And as we all know, that the United States actually collected tariff as is the primary source of revenue without any income tax from Civil War era until 1913. So you have heard about, both Trump and Elon have tweeted about this. So I think, just to answer your first question, will we have universal tariff? I think the answer is yes. And they are very serious about bringing tariff back as a minimum source of revenue for the government. You see, Trump actually set up a entity. He called it External Revenue Service, right? So I think the tariff, I think we will have tariff, and they were going to stay. And the next question is, how much can you raise from the tariff, right? And is that going to be universal, right? Or is that going to be targeted? I would say it has to be universal. Okay, let's just think about we all talk about we are running the biggest deficit against China and importing a lot from China. So the imports from China run about $500 billion a year, right? So if you want to raise a revenue of 500 billion revenue, right, you need to tax them 100%, right? If you tax them 100%, you get a zero revenue because there will be no import, right? And that's the reason there is no electric vehicle in the United States. And I would say if you tax them 50%, I mean, you can have a few hundred billion, but probably you won't be able to get that kind of revenue because the import will drop exponentially, right? So this is almost inevitable that a tariff has to be, applied more broadly. Now, the U.S. import are about 2 trillion per year, right? So you can use the easy math. Says, okay, let's just do 25% tariff, all of them. I will give you 500 billion, right? But then we have to ask ourselves, is that realistic, right? We know imports actually can be elastic, right? At the zero tariff, with free trade, your revenue from tariff is zero because there's no tariff, right? As you increase the tariff, the revenue will start to increase. But at the same time, the volume of the import will start to decrease. So at a certain point, your marginal increase of the tariff will bring marginal, the marginal revenue bringing will close to zero. And then you reach that point where further tariff increase will cause revenue to fall. And I don't think anyone knows what's going to be that tariff rate, meaning the rate that will maximize the tax revenue. By the way, we also have to differentiate, right? That tariff, the tariff rate to maximize the revenue doesn't mean that's the tariff rate that will maximize the social welfare of a particular country. But that's another topic. So let's say you have 10% tariff on 2 trillion, and that will give you 200 billion. Now, if you got 200 billion from tariff, and then you have if you have another a few hundred billion from some kind of defense and some kind of Doge initiatives, so maybe you can raise close to $500 billion revenue, right? I think at least that's kind of their within their calculation, So I think the question is, yes, there will be tariff. Yes, it will be universal. And the question you also say, would that be, have some targeted industry, targeted countries? I say yes, and that is true as well. And will they use it as a negotiating tactic? Yes, I think they will use it as a negotiation tactics as well. As you said, Trump already announced 25 tariffs on Canada, 25% of tariff on Mexico, and he associated with the immigration, drugs. In other words, the other political agenda that he's going to achieve, not necessarily economic agenda. And he certainly can reduce those tariffs to 10% or whatever, lower amount in the end. So that he can, claim a victory, on that. And, he's talking about the tariff against the European unions and all the other, Asian countries as well, not only just China, right? And most recently, he's talking about, he does not want to put tariff on China. He would rather not to. So that he can work out some of the deals with China. I think that the deal right in front of him is the TikTok. So how he deal with it, and I think it will give us a lot of indications, how he will proceed with the trade in negotiation with China. Let's not forget, I think one of the biggest things that Trump is doing this is that he wants to revive the manufacturing jobs in the United States, because most Trump supporters, they are the blue-collar workers in Rusty Belt, which have basically lost their jobs because of the globalization, because of the plants and the manufacturing facilities were moving overseas. And Trump wants to bring the manufacturing back, jobs back. And he certainly talked about it. He basically say, if you set up the plant here, you set up a company here, you produce here, you get 15% of the corporate tax, which is among the lowest in the world. Or if we import from you, we'll charge you very high tariff, right? So I think that's basically part of his incentive to create jobs for his supporters, right? Therefore, for some certain industries, the tariff will be so high that foreign countries basically are incentivized to set up manufacturing plants in the US. So to answer your questions, yes, there will be universal tariffs, I think. Yes, there will be differentiations between different countries and industries as well. And Trump will use them as a negotiation tactics as well. And I think part of his bigger goal is not only to raise the revenue, but also to revive the manufacturing kind of jobs in the United States.
Right. So so these things will happen, tariffs will happen. So what do you think will be the impact on inflation and growth? And what's the timing of these impacts, Jim?
Right. So I think you're right. We always think about things in terms of sequence, right? Because I think a destination is actually not important, because we do not know, in the end, how the things evolve, because things can change in between. But if we step back, from the very big picture, perspective, and I think, you and I were educated in a way that we know that the free trade basically optimize the welfare for every countries in the world. Because by taking advantage of the comparative advantage of their capabilities, people all over the world can enjoy the better goods and services with a lower cost, thus improve the productivity for everyone. In a sense, it's just extension of the labor division, right? People good at doing something, they focus on doing that, and they exchange goods and services. So it's just a labor division on the global scale. So I think globalization is good for everyone, and free trade is good for everyone in general, for the overall social welfare of all the countries. Obviously, this distribution of this benefit are not even, and can be drastically different. In terms of country, and I would say U.S. is the biggest beneficiary. You can think about this is that you can enjoy all the very good product and the services all over the world, and very low cost, and at the same time, those countries who manufacture these goods, they export to the US. Take China, for example. Once they get the US dollars, they recycle back to the US dollars by buying the US Treasury, by buying the US financial asset, and basically finance the US consumer spending. So you get both of the best, you get the best of both sides. You basically get to keep the cake and eat it, basically. So and obviously this have a lot to do with the US dollar as the reserve currency status. So obviously the other countries benefit from this too. I mean, it helped China's industrialization and the growth. But you also need to ask them at what cost. And they were able to build up an industrial basis and all this, but I think the real purchasing power of the consumers are depressed, and the lack of domestic consumption. And so within the US, right? I mean, the benefits are not evenly distributed as well. I mean, there's losers and there's winners. And who are the winners? These winners are multinational companies, right? I mean, if you look at the US corporate companies' corporate margin, since China joined WTO, it goes straight line up, right? So the US, multinational companies, they have a low cost production, yet very productive production in the other part of the world. And then they are able to charge good price here in the United States. And by the way, because the foreign capital recycle back to the United States, that will keep interest rate low, so the consumer can lever up and buy their product. So and that's why they will have a record high corporate margin. And who are the losers? And losers are blue collar, the U.S. workers, right? So they are really under the threat because they were laying off and they lost their job, right? And I think because China's upgrade into the high tech industry, and made in China initially about 2025, something they out 5 years ago. I think they have achieved most of their goals, and I think nowadays some high tech industry may be under threat. I think that will put up a lot of kind of urgency within the U.S. Political and the business elite, that is something that may need to some measures may need to be taken, right? So if you think about tariff is basically a impediment to this free trade and globalization, and it's starting of the reverse of this current globalization and free trade system. Then I think the beneficiary and is going to reverse. It's going to be the corporate corporate margins of the multinational companies is going to shrink, and then you will going to have more manufacturing jobs in the United States, and that's for the long run. We are talking about. Now let's talk about more in the shorter run. right? So let's talk about what is the tariff, right? Trump said it's external revenue, a service. It's not, right? As we know, tariff are basically tax on the importers, right? And importers can have two choices. Either they pass over to the consumers if the demand is strong, or if the demand is not strong, and then they will just shrink their own margin, right? And if the margin is too low, then they will just close the business, right? So tariff in the end is really taxes on the private sector. Is no different than any tariff that you're thinking about, income tax, whatever tax, is a tariff on domestic private sector. And when we think about tariff, it's basically a transfer of money from private sector to government. Okay, so that's a fiscal construction, kind of a fiscal contraction. As we know, in the past 1 year, the U.S. growth primarily was supported by the fiscal expansion, right? By the government. By the way, I'm saying fiscal expansion is positive for growth, but I'm not saying that is good, okay? Because fiscal expansion is good for growth in the short term, unless it's productive, it's bad in the long term, right? So now the tariff is the tax for domestic private sector, and I think it will create a negative fiscal impulse. So I think that is a negative for growth, right? Now, what is the on the inflation part? The goods, when people say, tariff, now people will have inflation, right? And the theory is very simple. You have to, the importers, they will pass the price to the consumers. And that is true on the two consumptions. One consumption is that you are able to pass over to the consumers because the demand for the consumers is very strong. And the second, assumption is that the demand for this particular product even is not dropping, and the demand for the other product and the services will not drop, which may not be true depending on the income, on the demand of the consumers, right? So when you increase the price, and if the demand, right, if their purchase power is not increased, then they may not be able to afford it, so the volume may drop. And some of the product may be, the demand may be inelastic, right? So they will buy them anyway. And then, but what are they going to do? They have to cut down some other discretionary, spending, right? So the import goods become very expensive. So what are they going to do? I mean, they're going to cut down maybe, eating out in the restaurant, maybe vacations, maybe private tutoring for their kids, things like that, right? So the demand for the other goods and the services will decline. And I think what's the real impact? Let's talk about the sequence, right? So in the very short term, and people may not feel the pain yet. So inflation may rise, and then over a period of time, people will pull back spending on the other areas. So overall, inflation pressure will actually start to go down. And I think even worse that if you do have the growth slow down significantly, and if this doesn't cause the asset prices to decline, because we know a lot of spending is basically supported by the elevated level of the financial price, and then you actually can have a deflationary shock, right? So I think it's depending on what time horizon you're looking at, and that's kind of the sequence we are looking at. We think in the very short term, it may support the inflation over a period. I mean, we're talking about like a few months out, right? And then a few quarters out, I think it will go away and even may cause deflation. And then over a long period of time, I think if a tariff become a global practice for every countries in the world, and you just think about basically reverse of the benefit of the globalization, and in the end is highly inflationary in the long run. So I just lay out this, kind of the dynamic of the inflation, through different time horizon.
Sure.
Don't know if that makes sense to you, Henrik.
No, it does. And yes, we have a lot of unknowns. We don't know exactly how fast and what is going to be hit and how the economy is going to react to this. So, but this is still some kind of well, this is an external event to the system. I mean, this is not a supply, sorry, this is not a demand-driven type of inflationary threat that we're faced with. So, what's the Fed going to do, do you think? How are they going to deal with this?
Yes. So I think to discuss this, we need to basically come back to the Fed reaction function, right? And I know that Trump tried to have influence in the race decision process, and he actually talked. He actually said he demanded the interest rate be lowered, and during his speech, I think it's in Davos speech yesterday, and I would say under Jay Powell, and he probably will stick what he think is right because his term is going to end in 2 years, not next year anyway. So I think he will do what he thinks that he should do. And as we know, the Fed reaction function is basically, so we are talking about the short end of the curve, right? And the reaction function we know is basically two things: inflation and employment. And in the past, we know, let's say talk about the current, status. We know the inflation has come down, but basically have a big stalling here, right? It's not continuous come down as before. Unemployment has gone higher. I mean, labor has been deteriorating, but then in the most recently, they has been basically stagnating again, stay there, and the unemployment didn't go higher or lower. I mean, it's basically status quo. So I think because of this, I think it's Fed is rightly so. Wait and see, right? So historically, if you look at the data sequence, and because the labor data is basically more coincidental data, right? If the economy fall into recession, then you will have employment numbers start to deteriorate at the same time. I mean, inflation is lagging indicator, right? And once the layoff started already for a certain period of time, demand fall, and then the inflation will start to go down. And so I would say, at the present time, if the inflation does not go up a lot, and if unemployment start to deteriorate, I mean, labor market start to deteriorate, meaning unemployment starts to go higher, then I think Fed will cut the interest rate, right? If the unemployment is, stay at the current level, and then because of the tariff, and the price, stay elevated longer than expected, and then I think Fed will probably do nothing and wait out. And obviously, if there's a new, if there's an indication that demand is picking up, and like you said, this is a supply shock, and but if demand is picking up, and then supporting the inflation and go higher, and I think Fed will not hesitate to hike interest rate again, right? And on the other hand, if unemployment start to go higher, and even the price, go up a little bit because of this of the imports, maybe the Fed may even look through and then still cut interest rate, right? So I think that's still actually possible. So, and obviously, I put a lot of conditions here, right? And my base case here is that if we do have this fiscal kind of a contraction that we are laying out right here, and the economy will start to slow down, and a lot of unwind of the federal government jobs that we saw last year, may happen in the near term, and that is going to be negative for the unemployment rate. And I think that in general speaking, I think the market is underpricing what the Fed, the magnitude of the Fed may cut interest rate.
Okay, this sounds logical. Now, how do we go from this logic to the implications for the financial markets? In other words, how do we profit from this? How can we, what trades should we put on, do you think?
Right. So I think two things we, to answer these questions, we need, there's two questions we need to answer. One question is that we need to understand, what are the, what are the risks that the financial market have already priced, priced in, right? And secondly, we also need to know that the tariff is just one of the factors that are impacting the financial asset. There's the financial assets are pulled by different forces, and the tariff is just one of them, right? So you cannot say, okay, something is going, because of tariff X, Y, Z, then I think something is going to happen without discussing the other factors, right? So it's a very complex, discussion. But I think that that we think all the financial asset, right, the one that is most sensitive to tariff will be FX market. So I think the consensus view is very clear that the tariff are very positive for the US dollars and very negative to exporters. Why? I think the underlying logic is basically this, the inflation in the US will be higher because of tariff, right? And then the other countries, they may devalue their currency actively to compensate the decrease of the export of because of a tariff. So basically subsidizing the US spending. I think the new advisor to the Treasury, Stephen Miller, right? He actually published a paper and talking about this. Or passive, or basically they, even they do not devalue the currency for the sake of the, the export. They may have to lower their interest rate, ease their financial conditions because their, export economic engine is slowing down. So they have to stimulate the economy, right? And that will, cause their currency to depreciate. So that's kind of the logic, and it all makes sense from the surface. And actually, that's what exactly happened. I mean, if you look at the US dollars, they basically bottom out at the time when the Fed cut the interest rate. I think first is basically because of the interest rate differential, right? You look at the US interest rate has gone up a lot. And I think gradually the market is pricing the possibility that the Trump would win. And then once the Trump, won the election, and the DXY in the US dollar just kept rising, right? So I think the question we have to ask ourselves is that have FX largely reflected this increase of the tariff, right? And will the tariff, be larger than what we expect? And I say I don't know about this answer, but all I know here is everyone is long US dollar, right? And I can imagine that if they increase the tariffs, if they do apply the universal tariffs and have very high level, and as a negotiation tactic, he may put the stake very high. And I do think the US dollar actually may sell off more. But I do see that if that happens, I do see that as buying opportunities to short US dollars. Because I think if we look at the not only just because of the the positioning of the of the market, and I say, and then they probably much have already priced in this the immediate impact of the tariff. But I think you have to look at the intermediary term. What's the impact of tariff will have for the on the economy, and like we discussed, that you have to look at the other side of the coin. I mean, tariff will hurt the real purchasing power of a consumer domestically here in the U.S. And then the negative fiscal impulse will result in a weaker economic growth, right? And the inflation, if materialized, may be very temporarily, and it can even be deflationary. So if you look at that, I mean, the recession risk will have increased, and interest rate in the U.S. may actually ended up lower, right? So that will take away the fundamental argument of inflation, of the stronger U.S. dollar. And this is because of the supply shock, as you correctly pointed it out. Even there's inflation, and even the nominal interest rate stay high, but the real interest rate may still be lower because of a high inflation, and that is argued against the stronger U.S. dollar. And look, I also see that I think one of the biggest problem in the world is that a lot of export countries, and they do not have a strong demand domestically because they rely on the export. And I think this may actually force them to do this transition. I mean, China has been talking about a long time to transition from export-oriented country, countries into the consumer-driven economy. And one thing I learned here is that you really need to, catalyst to force, people to make a hard decision and make a change. So I think they may be compelled to do, to stimulate domestic, consumption, which is good, for them, in the long run. So I would say, at the same time, there's indications that China and emerging market countries and even the other Asian countries, which typically are American ally like Korea, Japan, and the European unions, they were thinking about this, talking about trade among themselves. Here's the thing that if you put tariff on one country and you penalize that country. But if you put tariffs on all countries, and you may well penalize yourself, right? So, so I think that that the other countries may not competitively, if they want to, stimulate domestic consumption, they may not want to, devalue their own currency. I mean, I can tell you, most of the hedge funds in the world, they all short Chinese currency, and I would just caution that may not work out, and I see potential reversal of the U.S. dollar. Of course, I said it will really depending on the first reaction, right? And what's the magnitude of the tariff Trump will put it on initially. So now, how about the interest rate? And interest rate is impacted by a lot of more other things, right? As we talk about, and the tariff is just one of them. But I would say if we do not have expansionary, fiscal policy this year, which we do not think so, quite to the contrary, if we do have a contraction, kind of fiscal policy, and I would say that it will result into weaker economic growth. And if inflation does prove to be temporary, then I think interest rate in general will decline, and the rates will rally, right? So how about stocks? Stock is even influenced by a lot of other factors, right? So we know that stock valuation is very high, and we in our views, we are at the late and towards the end of the market cycle. And whether this can be extended for another 1 year or 2 years is really depending on whether we'll have a preemptive easing monetary policy and easing fiscal policy, which we have some doubts. And obviously, liquidity is the biggest driver, right? Our base case is like liquidity is going to decline in 2025, unless they restart QE. I mean, it's possible they restart QE. So, but in the absence of that, I think the liquidity is going to decline because the reverse repo is basically fully depleted, and there is a lot of needs to issue the treasury bond that need to be funded. So that's on the negative side, right? And on the positive side, I do think that I do agree that deregulation will be very positive for stocks. And now, purely from tariff perspective, we have talked about the tariff will penalize the multinational companies that have a manufacturing base overseas and have domestic clients, right? So I think that will hurt them, and then it will favor some domestic companies, right? And they are typically more kind of a small cap. some small caps. Now, if you look at a foreign, another I think a consensus is basically you put a tariff on the foreign countries, the export will decline, growth will decline, so their economy not going to do well, and therefore their stock is going to do very badly. For example, and I think a lot of people basically think the Chinese stocks will suffer because of the tariff. I think our thought is also, again, is contrarian in this perspective. I think, first of all, the foreign countries may be compelled to boost their domestic consumption, to stimulate their domestic consumption than they otherwise would be. They will be compelled to trade among themselves. But I think that the most important thing here is really the capital flow. Like I said, the whole world capital in the United States, because of the old model, is the old model of vendor financing, because people sell the things to the United States, they got dollar, and they use the dollar to buy the U.S. financial asset. And they have gone up. The investors are happy. So, I mean, recently the anecdotal evidence is very clear. I mean, the people from Asia and all over the world, and they are all trading the U.S. Technology, companies and the meme shares and the meme coins and and all these things. So the capital is here, right? And reduce surplus. By definition, you're going to reduce the amount of the capital available to recycle here to the U.S. And if there's if those kind of if those big multinational companies, right? And if the U.S. stocks, really, the performance is not as well, and if the currency, depreciate, and I think there will be reversal of this capital flow, and this reversal of capital flow will result into the outperformance of foreign stocks and the foreign shares. I think this is particularly true for the U.S. stocks, and a lot of people talking about the U.S. exceptionalism, right? And I would say, technology advancement, the attraction of the talent, and all this is helping U.S. to build, U.S. exceptionalism. And obviously, it's also built upon this globalization with the U.S. dollar as a reserve currency. So the deglobalization, try to reverse that. I think that's going to hurt U.S. exceptionalism. So it may well be at the peak of U.S. exceptionalism right now. Who knows? So those are my thoughts for the financial asset.
Well, Jim, that was a lot, and it's also quite a surprising and shocking, well, not surprising in your case, but a shocking contrarian take on the impact of tariffs. So in summary, I'm trying to summarize this. You think that Trump will implement some sort of universal tariffs combined with differentiated and targeted rates for certain countries and sectors. Trump is also using tariffs as a negotiating tool to achieve geopolitical and non-economic goals. He is incentivized to use tariffs to encourage foreign companies and multinational companies to set up manufacturing plants in the US. That's a stated goal. So from an economic perspective, you think imposing tariffs will hurt economic growth because ultimately it is a tax on domestic private sector consumption. The inflation picture is more complicated and nuanced in the sense that prices for certain goods may rise in the very short term because of higher import prices. However, this would result in lower demand in other products and services, resulting in a muted or even disinflationary pressure over the intermediate period, whatever that is. This is particularly true if the economy were to lurk into a recession anyway. Over the longer run, deglobalization and the fragmented supply chain means frictions, and frictions are inflationary for everyone. Other regions may be incentivized to trade more freely among themselves, for example. From the perspective of asset prices, you believe that the US dollar strength, because of the tariffs, may be overdone, and that the initial reaction may result in an even temporarily higher dollar, but it's a temporary move. Similarly, if you're right about inflation and growth, Interest rates may fall rather than rise in the intermediary term. While many factors impact the US equity markets, high tariffs are more positive for small caps than large multinational companies. Contrarily to consensus, you also think the tariffs are more positive for overseas stocks, particularly Chinese stocks. Does that reflect what you said?
Right, Henrik, that's a very good summary. So tell our listeners how they can follow us.
Right. So, well, this was the end. We've now come to the end of our 16th episode of Total Convexity. You can follow us by searching for Total Convexity in your favorite podcast apps, or you can find us on YouTube. Please don't forget to click on the subscription button so that you will be automatically notified when a new episode becomes available. You can also follow us on X, where we have the handle at Total Convexity. And you can email us at totalconvexity@gmail.com. And of course, you can follow our insights on Substack at totalconvexity.substack.com. Jim?
Thank you, everyone. We see you next time.
Disclaimer. The information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.